Okay, welcome everybody to episode 28 of the Volatility Barometer. We've got what is, I think, going to be a pretty good show. I think we're going to go through over quite a bit of data, largely assisted, of course, by the massive volatility spike we had yesterday. It's actually the problem that I had is how to reduce it down to a reasonable length. I could talk about big volatility spikes and what it means for the VXX and options trading all day long if you want to sit and listen. But I tried to condense it down for everybody. So we do have a lot to get to. I want to get into that right away. I see a lot of questions. We'll get to a Q&A, of course. Just one quick point, if there are some VTS community members watching right now, I have fallen a little behind in my emails, so I do apologize. If you've been waiting a couple of days for responses, I will get through all of those this weekend, I promise. As many of you know, I spent the last week in Las Vegas. That is a really difficult place to get work done. I'm quite good at traveling. I get all my work no matter what country I'm in. Las Vegas was just very strange. I think it was a little ambitious for me to get my full work schedule there. So apologies. I did get married, so something good came of the Vegas trip. For anybody who wants to know the backstory, super short version. I've been basically locked out of Taiwan for over a year now during the pandemic. And so as a last-ditch effort, we decided to accelerate our plans by a few months. We were going to get married anyway, but we officially got married in Vegas as a last-ditch effort to get me back into the country. So hopefully with that piece of paper, I'm finally going to be able to get back into Taiwan. So fingers crossed. But I have fallen behind in the emails because Vegas is just a nightmare to try to get work done. So apologies for that. Let's do a quick little intro, and then we'll dive into the topics, which I think most people will enjoy today. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so we've got a busy one today. We've got a bunch of segments that we do on the live stream, so that if this is your first time, the structure today, it does change from live stream to live stream. Sometimes it's hyper-focused on volatility products, sometimes options trading. Sometimes I'll talk about, golf and how that applies to life and trading and whatnot. So if it is your first time, please subscribe to the channel, come back often. You can give the video a like if you want, but let's get into the rundown. So the first thing we're going to talk about today is, of course, the massive volatility spike. As we saw yesterday, there was a pretty crazy day in the market. So we will get all through that data. The next thing we're going to talk about is unrelated to that, but I will tie it into the volatility spike as well. And that is we're going to review the differences between holding a long VXX put option through a spike like yesterday versus holding the SVXY, which is just a volatility ETP. We're going to compare the two and how they reacted a little bit differently during that spike. Basically talking about stock replacement and whether you should try to use options rather than the volatility ETPs directly. So let me just very quickly open my software. I was a little bit rushed this morning, as I always am. So let me open Thinkorswim real quick here, and then we will get started with that first one. Hopefully I'm not on screen share here, and everybody's going to see me typing in my passwords. Okay. So, wait for this to load. My internet seems a little bit slow today. Hopefully everybody can see me, hear me, and everything is going fine. Okay, let's get on with this first segment of the massive VIX spike that we saw yesterday. Of course, for anybody who is an active trader, you would have noticed yesterday that the market had a pretty rough day. It depends on the indexes you're looking at, but this is the S&P 500, down 2.27%. Now, the VIX index itself was actually up 54.04%. And that brings me to the first point, little side tangent before we get into the actual data. Because whenever you say something on Twitter, when you say, wow, the VIX spiked 54%, inevitably somebody's going to come along and say, well, the VIX is already measured as a percentage, so you should only look at the point moves, right? It moved 10 points yesterday. But this is just a side tangent, but it's a little bit of a pet peeve of mine. There are actually times, and it's probably fairly equally balanced, when looking at the VIX in percent terms matters just as much or maybe more than looking at it in point terms. There is no right answer to this question. It will always depend on the context, what you're trying to measure, what type of investor you are. If you're really just looking for the implied volatility, then yes, probably you would look at it for point moves. That would be the correct way to look at it. But there's plenty of times where the percent move is more relevant. And I would argue, and I'm going to mention it in a minute here, that given yesterday's move going from a place of stability, all right, the VIX futures were 10% in contango before yesterday happened. Going from that to an extreme spike, I find it far more meaningful to look at the VIX as a percentage change. So one illustration that I have here, and you can be the judge yourself. I'm not here to tell anybody, how they should or shouldn't think, but basically, which VIX spike of the three examples I'm going to give do you think would affect the average investor the most? These are the three choices. So we've got three VIX spikes here, all 33% changes, daily, one-day changes. One of them is going from 15 to 20, a 5-point move, implied volatility move. One's going from 30 to 40, 10-point move. Obviously, it's a larger point move. And then the big move, huge implied volatility change, a 20-point move in the VIX going from 60 to 80. So of these three, which one, and especially on a day like yesterday, going from stability to a big spike, which one of these would affect the average investor the most? Which would they be most concerned about? I would argue if you are getting hurt by VIX spikes going from 60 to 80, you've got a few issues with portfolio management, because by the time the VIX gets to 60, certainly you should have already rotated out of all of your risky positions, and this move would have just been one that you're sitting back and watching it happen, but it's not really affecting your portfolio at that point. At least it shouldn't be. If you're a buy and hold investor and you just watch your investments go off a cliff, then maybe, yeah, that would be pretty alarming to look at. This one is the same. If the VIX is already 30, going from 30 to 40, that's a pretty short trip, right? A 10-point move is large, but again, your portfolio should not really be that affected by this move. Probably the move from 15 to 20, as I would argue, this is the one that is the most meaningful. But as far as an implied volatility move of 5 points, that wouldn't even rank on any top 10 or top 100 list of VIX index spikes. 20 points, yeah, that's all the way near the very top. So again, I would argue that as well. And the second point that I would make just really quickly, if you are a specific volatility ETP trader like VXX, UVXY, in that case, you probably also find the percentage VIX changes a little more relevant because, of course, the volatility ETPs trade based on volatility changes in the VIX futures. And it's no guarantee, it's a long-term average, but the beta factor for the VIX futures, the VX30, combined M1, M2 futures, to the VIX index is roughly 50%, right? The volatility ETPs, VXX as the baseline, captures roughly 50% of the VIX futures moves. Now, of course, sometimes it over and undershoots. This is not a exact science, but long-term beta factor of about 0.5. Now, beta, I should probably mention the definition of that if you're wondering. Beta is just a measure of how much one security moves in relation to another. So the beta of VX30 to the VIX index, we're just concerned with how much the VX30 moves / the VXX in relation to the VIX index. It's not actually moving based on implied volatility point moves in the VIX. It's more meaningful to look at the percentages as well. But Long side tangent, little bit of a pet peeve of mine there. But I don't like when people say there is a correct way to do it. And every time you post a percent VIX change on Twitter, everybody bites your head off over it. There's actually plenty of times where the percentages matter more. So anyway, here we go with the percent changes. Now, I will get to both. I'll do points as well for all those people who think I'm wrong and it should always be points no matter what. That's fine. Not here to tell you you're wrong. But here is the largest percent changes. And as we can see, yesterday was number 4. This is going back all the way to 1990, since the beginning of VIX data that we have. 54.04% VIX spike. Number 4 all time. And it is a little surprising. Sometimes VIX spikes this large happen on relatively small S&P 500 changes. Now, sometimes, obviously, the biggest one, Volpocalypse, down 4%. That's pretty significant S&P move. There are plenty of times when it's more. For example, here's a minus 11.98, but actually only a minus 2.27. I would argue that that is probably because while the S&P 500 has been sort of marching higher the last 5 or 6 weeks, right, with very little interruption after that pretty large drawdown that it suffered in September, it's actually been going up pretty smoothly. The VIX index has been fairly stubborn during that period, right? You can see that would be this period here. Here's the September drawdown. The VIX, of course, it's actually been rising. There's been a positive correlation with the VIX and the S&P. So a little bit jumpy. I don't think it's overly surprising that a small sort of one day out of nowhere S&P crash would have triggered the VIX to spike so much. But again, 54.04%. If we want to go to the point moves, to appease all the people that only look at the point moves, a 10-point move is also significant. All right, of course, it's a little bit, the starting point matters a lot, as I illustrated. But again, it ranks as the number 18 point move as far as actual implied volatility move. So still very significant. If you'll just indulge me, I've actually done a full live stream on this subject because it is sort of a, I feel like it's an important, let me see if I can search it that way. I did a live stream here. It's VIX index, point versus percent. We went through the whole thing. Let me illustrate one more quick point while I have the data right in front of me. So if you look at the largest point move in history, remember this is implied volatility VIX move, 24.86 points. That is a massive move, right? Of course, as far as implied volatility, that's the big one. Certainly October 87 would have been higher, but that's the number one we're looking at. But if we look at the actual percent changes, or even better, let's look at the actual VIX index and see where that is. That's March 16th, 2020. That's this day right there. This is March 16th, 2020, this big green bar. Again, I would argue that if this day, the biggest VIX spike implied volatility move in history actually affected your portfolio, I think you've got a few issues to iron out, because clearly I think investors should be much more concerned with what happened down there, right? From here, going from 17 all the way to 25, this was the day that would have affected investors the most, not this day all the way up here. I mean, sure, it would have been alarming to look at, and we all watched it in somewhat horror, I would imagine. But this day on February 24th, this is the actual day we're looking at. If we look at the all-time VIX points, you can scan these later, but February 24th isn't actually on this list of the largest point moves because it went from 17 to 25. That's only an 8-point move. It didn't even rank in the top. But of course, it was a very alarming day and a very problematic day for investors' portfolios. So again, what affects investor portfolios the most? That day, a 46.55% VIX spike, very, very significant. And of course, meaningful in the grand scheme of portfolio management right there. Again, if you haven't cycled out into full safety by this point, well, then you're a buy and hold investor, and you're probably very thankful the Fed came in and saved you, because at this point, you're down 35% in your investments. I basically cycled out of all positions before February 24th and on February 24th, but neither here nor there. That's another reason why I don't like the point moves. But anyway, no matter how we look at it today, it was a very, very significant day. Number 4 all-time, number 18 all-time. Pretty rough day. Now, I'm going to venture a guess that most of the people who follow me are at least somewhat interested in volatility ETPs, right? The VIX itself, and I always say this, that while it is the most well-known and the most quoted in the financial media, it's actually not overly useful. When I look at, say, if I had to rank my top 20 most important metrics that I track, I'm not sure the VIX would make it on that top 20 list. The only time I'm ever actually using the VIX is if I'm using it in comparison to something else. Relative to other things, it can be very useful, like the VIX index relative to the VX30, for example. That roll yield is very important. The VIX index relative to the VOLI index, for example. VOLI is at the money SPY option, implied volatility, and the VIX is a whole strip of all out, in the money, out of the money. So the residual there can be very meaningful as well. But the VIX itself isn't overly useful. I think what people are really more interested in today, certainly if you follow my work, is what that did yesterday to the VXX. And of course, by proxy, the UVXY as well. But the VXX, largest spike since 2004. This is using simulated values before it launched in 2009. But you can see right there, it was actually the number 4 largest VXX spike in history. We've got 17 years of data here. So super historically significant volatility spike yesterday. Obviously very problematic for investors, because if you'll notice, one of the columns here, the previous day's M1, M2 VIX futures. Now, just to get everybody up to speed, in case you don't know what I'm talking about, the volatility ETPs only trade based on the front 2 months of these VIX futures. They're holding a combination of these two. They can hold swaps as well, but it is essentially replicating and tracking what these two futures are doing relative to the VIX index as it approaches the expiration. So looking at this VIX curve is very important for the VIX futures. So I've got that one column highlighted. A lot of people are looking at the value of contango to maybe be the sole contributor to their trade signals, or maybe just among several things they look at. But if you can see, all 4 highlighted in blue, VIX spikes this year, and if we actually go back a little further, there was a 5th one, almost made the list at 1427, not quite. But there's been 5 major volatility spikes this year alone, and we're only into November. Who knows what's coming next? But 5 major volatility spikes, all 5 of them happened with high contango, higher than long-term average the previous day. So 1080, 1258, 758, 715, 1035, all 5 volatility spikes this year, you could make a case that they were sort of came out of nowhere. Very difficult for investors to have any reason to think the previous day, this is November 24th, the day before yesterday's big spike. No reason not to be short vol here. This is a healthy curve. The markets are healthy. So I guess long story short, if you are a volatility ETP trader this year and you find yourself a little bit disappointed in your results, that's why. It's because while the VXX itself, on an absolute basis, is doing reasonably well this year, there's been 5 VIX spikes along the way that have been massive killers for anybody's forward momentum here. And another point that I always like to illustrate, like I said, the VXX itself does appear to be having a reasonably good year. When you look at it on a chart, remember, it basically just decays. It's a insurance product. It's like holding a long option. Right? It will decay, and there is theta decay over time. It's an insurance product. This is the natural expectation of what is going to happen long term, minus some major spikes along the way. But the point is that this is not the experience of an actual trader, because investment returns compound geometrically, and traders don't buy and hold these products. I certainly hope not. I don't want to say for sure, but if you are buy and hold the long-term or the long volatility TPs, again, I would suggest you dive into my work. I can explain why that is not a good idea. But this is not the experience of the average investor. What you really want to look at is what the VXX has done on a daily rebalanced, essentially a compounded geometrically performance curve. This is what the VXX actually looks like daily rebalanced since January 1st, 2018. So this is since basically Volpocalypse. This is the VXX's actual performance with respect to how people would more closely trade the product. Right? Anybody can look at something, it started 4 years ago and it's dropped down. If you just shorted it, buy and hold, and closed your eyes, yes, the VXX is down significantly. But that's not how traders trade it. So it's very misleading. Sometimes you'll look at people on Twitter, they're posting charts like this, and they're telling you all you have to do is just short it blindly, close your eyes, and money falls from the sky. That's actually very far from the truth. When you're actually talking about geometrically compounded investment results, it can get pretty nasty with things like the VXX. The reason, somewhat like we've been seeing this year, losses are extremely punishing, whereas gains take a lot of time. So here's the loss during COVID, right? Oh, I shouldn't have said that word on YouTube. Here's the loss during the pandemic, the sickness, as we'll call it. Crushing, devastating loss. It's going to take the VXX a very, very long time to recover from that, right? It's not even close. It's still in a current drawdown of 61% since the Volatility. When something that bad happens, it could take years. And this is why I always like to illustrate this. Make sure that the people you're following on Twitter are not posting the absolute return of the VXX as a downward sloping curve and saying, look at how easy this is, just short it. That is not an actual trader. That is a person who tweets. People who actually trade these volatility ETPs, who have a tactical system of rotating in and out of positions, may have actually found it quite difficult this year with 5 volatility spikes of anywhere from 15 to 27% single day losses. Those are far more punishing than all those gain year or those individual days. This loss, if you suffered it, and I did as well at a half exposure, so I lost about anywhere from 10 to 13% in my volatility strategies, it's going to take a while to recover from that, right? It doesn't happen overnight. And compounded geometrically, that 14% loss or 12% loss, it's going to take much more than a 12% gain to recover from. That's the essential point. So make sure the people you're following are actually showing you the real chart of how difficult these products are to trade in real time. It's very easy to look back in hindsight and say, well, look at this. It's just short. Look at all the money I made. Did you? Where's the performance report? I'd like to actually see the real results. I bet you they don't look like the inverse. I bet you it looks a lot worse than the inverse of that chart. So just be aware of that VXX, not such an easy product to trade. And the reason is not because of the losses or the gains. 80% of the time you're going to be making money. And it's going to seem like the easiest thing in the world. The reason why it's so difficult is because of days like this, especially when they pop out of nowhere, right? There's no real reason not to be short vol heading into Friday. And I would imagine everybody watching this stream right now felt that pain, or at least most people. 5 major volatility spikes just in the last 11 months. Pretty significant stuff. So the question becomes, what's going to happen on Monday? All right. Anytime something like this happens, now you get a lot of chatter. Well, is the market going to recover huge on Monday and we're just going to forget the whole thing? That has been the trend recently. We are in a buy the dip environment, and most of the time, volatility spikes do get faded. I don't know what percentage, let's say 70, 80% of the time, those big spikes, they only last a couple of days and then it fades back down. So there are people that are already piling into the short vol trade. The other way to look at it would be from a long-term investor perspective, like you're trying to build a retirement fund over multiple years and maybe multiple decades. Certainly now is not the time to be piling into short vol trades, right? Hopefully you have some context of history and understand that while that does work most of the time, there have been some times when it doesn't. And I actually responded to somebody on Twitter who said that. Basically, the spike's going to get faded. Now's a really good time to dive in. I basically reminded him of 3 days that wouldn't have worked. There's been dozens, right? I didn't have time on Twitter to post dozens, but obviously during Volapocalypse, February 2nd was a Friday. Market was down pretty big. VIX futures moved into backwardation, 4.16% backwardation. There was a lot of people on that Friday, February 2nd, who were on Twitter saying that it's a perfect time to short vol. And I actually got into it with somebody. I'm always polite, but somebody was mentioning that. Somebody actually pretty popular. If I said his name, you'd know exactly who it is. I actually got into a public debate with them on that Friday and through the weekend. It carried through the weekend, basically being called an idiot for being conservative right through the weekend. I was the one saying, no, when the VIX futures are backward and Friday is an ugly day, you really do have to wait for confirmation of this signal because you could get really hammered on Monday. They're like, oh, you're crazy. It's, whatever. And then, of course, on Monday, Volapocalypse happens. The XIV is terminated, and however many people out there lost, their trading accounts, that person included. Let a whole bunch of people off a cliff, deleted all the past tweets, you know the drill. But essentially, I just want to remind people that does sometimes happen. The second one, August 2015. If you remember, hopefully people remember that, August 21st, 2015 was a really bad day. That was a Friday. Well, pile into short vol, there's August 24th, Monday, 2015. Another devastating loss. This was a 45% VIX spike. And then the next day, or it was a 46, and then the next day on Monday, it was a 45er. So again, very, very painful if you're going to be piling into the short vol trade. And again, need I remind you that Black Monday is a Monday. That's why it's called Black Monday. October 1987, it was actually, the VIX went up to 30 on the Friday. So it spiked huge that Friday. Back then, we didn't have volatility ETPs, but if we did, there would have been people on Twitter, if that existed, saying now is the perfect time to short vol. Well, was it? Because then, using the old VXO calculation in 1987, VXO uses the S&P 100 options, so we can actually drag it back 4 more years to get some data. Friday, the VIX went to 30. On Monday, it went to 150, actually 172 intraday. So again, these types of things do happen. Not often. I agree with people who say that most volatility spikes get faded. That is a fact. It does. And if I was a betting man, which I'm not, especially with my long 30-year portfolio, I'm not a betting man. But if I was, I would say more than likely, history tells us that on Monday, the markets will be up, volatility will get crushed, and probably within a few days, maybe by next Wednesday, the S&P will be at all-time highs again. That would be my mathematical bet. If I looked at historical facts, that's what you would say. But is that little gain, trying to capitalize on that vol crush and trying to catch the 2% that we lost Friday, trying to catch it on Monday and Tuesday, is that worth what could potentially happen if this news over the weekend is digested or if there's another bad news headline? Let's say the news headline, instead of saying, you know what, this is probably going to be just like the Delta, it's going to go away quickly. What if the news headlines tomorrow night are, wow, we actually underestimated this. This is a real problem. Monday could be a super ugly day. And the risk-reward ratio of getting it right versus getting it wrong is not equal. These are not symmetric on both sides. The going through the weekend short vol because Friday had a big spike is not a symmetrical outcome when you've got things like Black Monday, when you've got Volapocalypse on a Monday, you've got August 24th on a Monday, you've got the European debt crisis, same thing happened. Big up on Friday, even bigger on Monday. These types of things do happen. So I don't know what the news is, and I'm not a macro investor. I don't use those types of news events to influence my trading. Volatility metrics only. But if I'm telling you, on a risk-reward perspective, now might not be a very good time to be piling into the short vol trade. Even though statistically you will probably be right, if you did that 10 times in a row, long term you're going to lose more money than you make. So sure, you could maybe eke out a little percent here and there on Monday and Tuesday, but not worth it. My email inbox on February 5th and February 6th, 2018 would make any man cry. There were stories, I don't want to get too grim here, worried about losing their wife, their family, their children, their money, their retirement funds gone. It was bad. I get emails on those days where everybody heard something on Twitter and thought, oh, this is the smart thing to do. Not worth it, folks. It really isn't worth it. You've got a 20 to 30-year time horizon to build your money. And as I always say, losses are more costly than gains are beneficial. This is not a symmetrical outcome. So what's going to happen on Monday? Who knows? It's going to be interesting. I'll be there with the open. We'll see. But I would say that if you're a short vol trader, I hope you didn't pile into shorts on Friday. And if you did, I'm cheering for you because I'm on the sidelines. So I hope that it doesn't crush a whole bunch of other people. So let's get into the second subject here. Another one that I think people might find a little bit interesting is the idea of stock replacement. Let's get rid of the Joker here. He served his purpose. He's sufficiently scared everybody watching into thinking that a vol spike is the perfect time to short vol. It most certainly is not, folks. That is a long-term losing proposition. So let me gather my thoughts here. Stock replacement. I've got two strategies that are specific to volatility ETPs directly. We've got a third that uses them, but it also uses stocks and real estate and gold. But we've got two strategies that are hyper-focused on volatility ETPs. Make sure I'm screen sharing. Good. So the aggressive vol here, as you can see, it uses the SVXY. And 1/2 VIXY, if things get really bad, we can go long vol. Only happens on about 2 to 3% of trading days, so we're not nearly there yet. These dials are actually not updated. Let me use Friday. Here's that spike. Here's what it did. So this strategy just barely almost exited to safety, but didn't. So this, I am still long SVXY just by a thread in this strategy. Everything else moved out, rotated into safety, but aggressive vol hung in there. But the point is we're using SVXY, volatility ETP. Down here, I say, if you prefer options, this is the option that I would have put people in, right? Long the 18 March 2022 VXX 31 put option. Our other volatility strategy, tactical volatility, this is more conservative, so it did rotate out and into safety, back into cash. It moves out basically at the first sign of trouble. Aggressive vol can hang in there. That's why it's called aggressive vol. But this one uses stock replacement with VXX put options, long-term VXX put options. Now, if people want to use the volatility ETPs, they can, but we've got two strategies, totally different volatility metrics that each one of them are tracking. They are geared differently. They rotate at different times. They are totally different strategies. And they use two different ways of going about it. One uses VXX options. The other uses the SVXY. So the question is, which one is better? And I want to highlight one specific thing in this segment today. I do a lot of stuff on stock replacement, so it won't take you long on YouTube to Google and do a little search. You'll find 2 or 3 full tutorials on it. But let's go through it a little bit quickly today. So the advantages to, first of all, using SVXY over the VXX stock replacement, the first one would be ease of use, right? Options are very easy, but there's a little bit of a barrier to entry there. Some people get intimidated when they see options, so they might just want to use the ETF. It's trades no differently than a stock. You just buy and sell them. That's one reason that SVXY is easier to use. And the other advantage would be that SVXY does not have any theta decay. When you're dealing with options, there is a little bit of a decay factor there because, again, they are basically insurance products. They are a long option, and there's going to be some decay. That's why I like to do them so far ahead of time, 100 to 130 days in advance, rebalancing if it gets to about 80 or 90 days to expiration. There's not a whole lot of theta decay that far out on the curve, but that is one advantage. On the flip side, there are many advantages to using VXX options. The first being the maximum loss is capped at the premium you pay for the contract. Now, anybody who saw what the XIV did in the past and the SVXY before it was deleveraged from 1 times to 0.5, they lost 96% of their value in 1 day, right? So when you're dealing with options, if you're looking about a VXX option, and maybe this one with 111 days is appropriate, what you'll notice is that the premiums are much smaller than the actual capital outlay for the ETF itself. So with VXX trading at 26, one option contract is 100 shares of the underlying. So one option contract of, say, this 30 strike, which would be, it's a reasonable trade. Maybe the 35 would be more suitable. You're looking at about $1,470 in premium. That's $1,470 because you multiply by 100 per one option contract. So if the worst happens, if Black Monday comes again and the VIX goes from 28, where it is now, to 150, just like it did in October 87, the volatility ETPs would be decimated. All of them, on the long side. On the inverse side. The SVXY, even the fact that it's deleveraged, it would be terminated. I'm quite sure of that. But When you're trading the options, you can only lose the premium you put up. So no matter what happens, you can only lose $14.70 per one contract, $1,470. So this is significantly safer on the worst possible outcome days, on your Black Mondays, on your Volpocalypse days. Trading stock replacement with VXX options is actually a safer way to go about it. I'm not saying it would be a fun day for this person. They would probably lose almost all of that premium. It would go extremely low, I would imagine, maybe not quite to zero, but it would go pretty low. But again, you can only lose the money you pay. Second advantage, it may reduce losses on large volatility spikes due to being Vega positive. This is the point I'm going to highlight in a minute with an actual example. But really quickly here, there's the 35 strike. You can see the Vega is 0.05. Vega in the options world, loosely speaking, is what happens to the option contract given a 1% volatility move in the underlying. So if we see a 1% VXX volatility change, this contract would go up 5 cents. It's positive Vega of 5 cents. Not much, but there's a little bit of positive Vega there, which means that if you do get caught, out in the rain without an umbrella and the VXX spikes on you out of nowhere, there is a little bit of a factor there, which probably means you won't lose quite as much money as the people holding the volatility ETPs directly, because you'll get a little bit of a bump from that Vega. Now, it's not nearly going to offset the delta losses, but there is a little bit of advantage there. And I'll circle back to this in a second, and I'll illustrate that with an example. The third way, it allows us to custom design leverage factor by selecting our option delta. Apologies for the options lingo. I always keep things as simple as I possibly can. You don't need to geek it up with high-level math to be a great option trader, but you do have to know basically, what delta, theta, vega, sometimes gamma, some of the basic ones. Delta is essentially how much exposure this option has to the underlying. So this 35 has a delta of 0.5. Loosely speaking, if all things are held constant from one day to the next, a $1 move in the VXX would affect this option by 50 cents. That's the delta factor. But you can see they are different. So when you're talking about the SVXY, it is a minus 0.5 inverse volatility ETP. It's 0.5. But with options, you can actually choose the delta factor you want. Now, in this case, we don't have what we would usually have because it's following a very large volatility spike, but sometimes you can go all the way up to 0.65, 0.7. There are other options available. Right now, it looks a little goofy because we are one day removed from the fourth largest spike in the last 17 years. But you can custom design your delta factor here, which actually is a pretty significant advantage. Let's say you wanted to simulate something with a higher leverage using the options. You could very easily do that. You could just buy this one. This one is only going to cost you about $8 per contract. But if you bought two of these, now your 0.4 delta is 0.8. You're getting very close to simulating the VXX with options and only spending $16 rather than $26 to buy the actual ETF or to short the ETF, which has a myriad of problems on its own. Don't ever short them directly. But the point is, with delta and adjusting the contracts, you could do 3 of them with the same capital. You would even come in under that. So you could do the 0.42 delta, cost you $8.75. You could do 3 of these, and you would be at a 1.3 VXX. You'd be approaching the UVXY at that point, and you'd be using long options, which is safer than shorting the UVXY directly. Much safer over here. So point is, there is significant delta advantages as well to using stock replacement. And the fourth point may not affect you, but it is significant for a lot of people out there. Defined risk options can be traded within most account structures. Not all. There are people who will not get the permissions to do that. But most people in most countries around the world can actually trade options. I hope I'm on screen share and I haven't just been looking at the screen all day. Yes, so there's 2 situations that this would apply. The first one would be there are actually account structures because the SVXY is an ETF and it has specific tax treatment. There are people who actually can't trade it directly. They're just not allowed to hold it within that account. So in that case, you could try to use the VXX options and you would probably be allowed to do that in the same account. And the second one is affecting all my European friends out there. If you go to my website and you search out, if you're anywhere in the economic area, European economic area, search out MiFID, and you'll see this article here. Unfortunately, there are some pretty strict regulations against Europeans holding US-based ETFs. So they require KID documents and translations and all this, and they're just not available. So Europeans can't even buy the S&P 500 ETF. They can't even buy the SPY. So when you're talking about SVXY, of course they don't have access to that. The first solution would be to just find replacements, right? I've given several examples here for stocks, for bonds, for gold. But the second option, of course, is stock replacement through options. Europeans can use options on VXX, and they can participate in the short vol trade without requiring the KID documents and all the MiFID II regulations that basically stymies them every time they want to trade something that they'll see on Twitter or they'll see people talking about. They don't have access to any of those. So stock replacement, of course, does make it available for a vast majority of investors out there. So if you're ever having difficulty getting the SVXY approved in your account, call your broker, ask them about VXX options, get your approval. It is just long-only single strike options, so this is not complex spreads. This is the lowest level of options approval you would need. It is a long-only put option. Basically, every account structure out there can do those. But what I want to circle back to is this one. It may reduce losses on large volatility spikes due to being Vega positive. What do we mean by that? And we're just going to use yesterday's example to illustrate this. So the SVXY yesterday lost 12.8%. Pretty big loss. I mean, you can see what happens to the SVXY on these days. It takes quite a while. Even in a strong buy the dip environment, it takes quite some time to recover to the same point. So anyway, it was down 12.8%. What we can do, certainly your software will do it as well. Thinkorswim makes things very easy. You just use the think back. We're going to go to VXX, and we are going to look at November 24th. And I'm going to pick an option that I would potentially have been holding through that time. I'm going to pick a 0.5 delta option, right? This one right here. Because remember, the SVXY is a 0.5 times leverage factor. So this option would be $8.10. The next day, it spiked up, or down. Of course, the VXX spiked up. The put option, the long put option for 114 days in advance, went down to 645, it looks like. And VXX is very liquid, so you wouldn't have any trouble getting 645. 645. So using our little calculator here, I know this is frustrating for people to watch. Slow at typing. 810. That's how much this option actually lost. It went from 810 to 645. So this option actually lost 20.37%, but it's a delta of 0.51, so we have to actually adjust the delta factor. This option would have lost 10.39%, right? So we can compare 10.39 to the SVXY losing 12.8. It's not a lot. There's about a 2.4% benefit there to holding the VXX option through that massive volatility spike. And the reason is because it is Vega positive. Remember, there is that 5 cents or so, whatever it is. And when you're talking about that massive volatility spike, well, it was significant. Remember, Vega measures, all things being held constant, what a 1% volatility spike in the underlying would do to the option contract, 5 cents. Well, what about this spike, right? This spike on the VXX went from 79 to 134. You're talking about a very big spike there, 55 points basically spiking. So that's a lot of nickels that you're picking up. And essentially the end outcome was the person holding the long-dated VXX put option would have lost 10.39, we said, and a person holding SVXY, they would have lost 12.8. Both traders, not happy campers. Obviously, volatility spike out of nowhere when the VIX futures were over 10% contango the day before. Not a whole lot people can do about that. If you're not short vol on basically, Wednesday, November 24th, I don't know when you would be, right? If that day you weren't short vol, then you're not a short vol trader because everything was kind of green light and every short vol trader probably lost money on that day. You're not short vol when the VIX futures are 10% contango. And for me, going further, my volatility barometer was under 50%. Hey, when are you going to be short vol? It's not the perfect green light. It wasn't the best time. As I said, there's a positive correlation of the VIX and the S&P in the last month. But surely, I mean, I was short vol. I don't mind saying it. I lost my 10% with my VXX option. I lost my 12% with my SVXY. I did too. The last thing that I will mention really quickly, this is more of a just a warning. I know there's a lot of people out there that are, patiently waiting. And we will say patiently waiting, but are we really patient at this point? Waiting for these new volatility ETPs, SVIX and UVIX, to finally launch, right? SVIX is essentially, with a much better underlying structure, it is a replacement for the XIV, and the UVIX will be, again, with an improved structure, hopefully, an expanded window of rebalancing, it will be a replacement for the old 2x TVIX. So, I mean, I've done videos of these going back to December 2019. So I say patiently waiting, not so patient anymore. Let's get these things going. But my point here is that just remember, the SVIX, if it was live right now, and if you were holding it, you probably would have lost over 25% in one day. So just because these things are going to launch, right? All indications are that they have been approved, flagged, prospectuses, all done, probably in December, at the latest January is when I'm predicting it. We're going to see them. The question is, are you going to use them? I'm not sure if I'm going to use it yet. I'm sure there's going to be something that I do within my broad portfolio of VTS. We've got tons of strategies. We've got the VTS options, which is another 10 more option strategies. I'm going to use the new products as well, especially since it seems like they will have options quite quickly. How you would use them, though, be careful, because one-day spikes happen, as we saw this year. 5 of them, all 5 times the previous day was a green light for short vol. People got hit with all 5 of those. You don't want to lose 25% single day 5 times in the same calendar year. So you probably want to not rush into it and make sure that you are a successful tactical investor that has a demonstrated history of reducing drawdowns. If you're just a short vol player and you're new and you don't really know how these markets work, and you weren't doing it back then when it spiked, 96% and tears and talk of suicide and all that stuff. If you weren't around back then, dip a toe, it's fine. As I always say, trade as much as you can, trade off, and learn these skills. This is the most valuable thing you can do in your life, really. I mean, building financial success, very few things more important than that. I mean, it bleeds into all aspects of our lives. It'll help your relationships. It'll help your health. You can afford better stuff, gym membership, higher quality food. It bleeds into your relationships. You can take your wife on a trip to, hopefully not Vegas like I did, but take her on a trip to Hawaii. You can treat your kids to things. Financial success is vital. So trade often, learn these skills, but keep it small. Don't dive into things just because you saw somebody on Twitter post a few charts. That's not a track record. That person's not a real trader. Be very careful, because if SVIX was around right now, would have dropped about 26% yesterday. Wouldn't have been a very fun day. If the old TVIX was around, there were people, crazy enough, shorting the old UVXY, which was a 2x product. Not a fun day yesterday. A drawdown of, 50%? Takes a full 100% subsequent rate of return just to get back to break even. So banks, they will allow you to do what you want for the most part. They will these issuers will provide the products for you to either benefit from them if you know what you're doing, or basically hang yourself if you don't. The products are there for us all to use. I like to be my own risk manager, so the more products, the better. How you use them. Don't rush in. Be careful. Volatility spikes happen all the time. As we saw yesterday, they really, really do happen. And when they do, quite often, it's out of nowhere. This is another thing that, I'll wrap up on this, I promise. But there's a lot of people who talk on Twitter about how you're always going to see them coming. And, it's okay, I'll just stop loss out. Or it's all right, I'll just cycle out into safety when it happens. It's not all right, because quite often they do come out of nowhere. That's what volatility spikes do. That's what a black swan means. It's called a black swan event for a reason. It's because you didn't see it. It's rare. You can't see them coming. Stop losses don't count. It gaps overnight. You're sleeping. Your stop loss is not going to trigger during that. And if it is, it's a massively fast-moving market. Remember, the VIX futures is what caused the termination of XIV. You're going to try to get your trades in when something is spiking 50 or 100%? I don't think so. So just be aware that risk needs to be managed before the crisis, not during. If you're managing your risk during, unfortunately, it's already too late. So just be aware of that. There it is, number 4. Wow, that was a day. I got hit. Let me go back to the screen share. I don't know what I lost today, but just in the interest of full disclosure, sometimes I like to just remind people that even people, and I'm not bragging here, but quite successful for a number of years, 15 years or so. But sometimes it's a good reminder to just have people like this not go on Twitter and talk about wins all the time. Let's talk about some losses. I lost some money too. It wasn't any fun yesterday. So I'll give you my exact, just for the live stream. I'm not going to tell you my real portfolio. I always keep my net worth and whatnot private. I think it's kind of gauche to talk about money, but this is a public fund, right? This live stream account, I don't mind showing it. That's what this is. This is it's live capital, but this is just a demonstration during the live streams. So I have something to show, and I don't have to be careful where I'm clicking or the numbers that I'm showing. I actually do prefer to just track a model portfolio. And then again, like this is my Thinkorswim. I don't have to worry about if this says my name somewhere or, my account numbers. I don't want to be coy with it. So that's what this account is. And we lost 265 to 274, $9,000. So that's not fun. $9,000. I don't know. What is that? That was a bad day. It wasn't quite 9,000, but my loss, added a 0 there, 3.2%. So yeah, not a fun day. This is all leveraged. So I lost more than the broad stock market yesterday because in this account, I'm actually only tracking the leveraged versions of our strategies. I've all rotated into safety, of course, but yeah, there it is. Somebody who's showing you losses. Who knew? People actually take trading losses sometimes. Yeah, it was out of nowhere. So if you've had some struggles this year, I feel you. 5 spikes out of nowhere, all 5 days. The previous day was a green light. Yeah, it's been kind of a rough year for some people. So understandable. It doesn't look like it. If you just looked at the chart long term, start here, end here, it looks like, oh, everybody should be up money. Live trading this year has been a little bit problematic. So anyway, let's get into the Q&A. I did notice there's a lot of questions. There was a couple of questions. I'm going to just start right at the top and go down. How much time have I got here? Oh my God, I wasted everybody's time. So today's going to be a longer live stream. Sorry about that. Hopefully in my 50-minute presentation there, you saw some data that you appreciate, but I saw really good questions. So I'm going to answer at least 5 or 6 of these. Let's get started. First one I'm going to actually show. I saw it earlier. That is frustrating because there's some really good questions before I clicked live. How am I going to do this? Top chat, live chat. It doesn't see. This is the problem. It doesn't show me all the questions, and then when it goes to my trading software, it doesn't show them. Give me a second here. I saw it. I remember seeing it. I actually prepared a little bit. Sorry, I'm going to go to the third question, and then if something pops into my head, I'm going to circle back to it. If not, I'm going to make a private video later on. I'm going to read that question if I can find it somewhere. We're going to do that. But let's go with this one here. How long it takes for VIX to recover from a big peak to get halfway back to return its long-term average. Okay? Good question. So let's unpack that. I want to attack that last bit first because it is quite relevant when you're talking about the VIX index specifically. You said to return to its long-term average. What exactly do you mean by average? Because with respect to the VIX, it's easy enough to calculate what an average VIX is, right? I can tell you exactly, since 1990, the average VIX is 1949. So are you talking about how long it's going to take the VIX to get from the current 28 something, I believe, 2862? How long is it going to take to get back to 1949? Or are you talking about the median, which is the middle value of the VIX? Half values above, half values below, right? Of course, with the VIX index, high values are much higher than low values are low. So, I mean, these, on this side of the tail, these are massive numbers that are going to bring up the long-term average significantly. So the mean is going to be very high. The median is 1744. So do you mean how long it's going to take to get back to that? Or do you mean the mode? The mode is the number that occurs most frequently in a data set. So the mode of the VIX is actually 1242. The VIX spends an awful lot of its time in the 12s, 13s, and 14s, and even the 11s. These four columns are really, the VIX spends a lot of time down there. So what I always say is, sure, the long-term average is 1949, but I think when you say what is an average VIX, it's probably closer to 14. So again, I'm kind of nitpicking a little bit at your question here, but what do you mean by average? I'm going to assume the mean, because certainly we've been in a period for quite a while that we're not getting down to those 14s and 12s and 11s. It's been ages since we've seen those. So let's just go with the mean. But just know that when you say get to the long-term average, in my mind, the average VIX is about 14. It's certainly not 1949. That's being dragged up by a lot of days that decent portfolio managers, those days are not going to be affecting your portfolio. If the VIX is 60 and it goes to 82, it's just, I mean, get your popcorn and enjoy the show, but it's not going to affect your portfolio, or at least I hope it isn't affecting. You should have been cycled out long before that. So how long is it going to take the VIX to get from 28 to 1949? Well, this question has no answer because it really does depend on not only the magnitude of the spike, but the duration of the spike. So if you're talking about Friday, one day it went from, I think it was what was it? What did we say? What was it the day before? It was 1858 and it went all the way up to 2862. So how long is it going to take to retrace that? Or at least what you said is retrace half. If it is a one-off spike and on Monday everything is stable and calm, while it is the number 4 largest VXX spike in history, it's only one day. So that could be recovered quite quickly. We could see vol crush within 2 or 3 days, and the VIX could be back down to the teens. But if it lasts several months, then it really does take quite a while to chip away. And you're talking about retracing half of its move. On a one-day spike, it could retrace half in a single day. Monday, it could be at 23 or 22 or even lower. But if this lasted a while, you're talking about a retracement that's volatility is going to be sticky at that point, and people are going to be really legitimately scared, and they're not going to pull off those hedges quite so quickly. So I would say, like I said previously, most vol spikes are faded quite quickly within 2 or 3 days. Kind of it's never really happened. So probably by next Tuesday or Wednesday, historically speaking, the VIX will probably be in the teens, 70, 80% sure of that. You just want to be very careful of that 20% that's lurking out there because things can go. The VIX going from 28 to something over 40 is a very, very short trip. Going from 18 to 28 takes a significant scare. Now that it's out there, boy, it doesn't take much at all to see these things just run for a while. So unfortunately, your question doesn't have an exact answer. But like I said, the average VIX is probably 14, not 20. And a one-day spike won't take long at all to retrace. If the market likes Monday, it'll be in the teens in no time. If it doesn't, all bets are off. Hopefully nobody's short vol over the weekend. Okay. If you were to buy a put right now on the VXX, what strike and expiration would you choose? And please explain the reasoning for it. Okay. We'll go through it. I wouldn't, but that's only because tactical volatility cycled out of a trade. I am, like I showed before, I am still just hanging on by a thread to a 10% allocation to SVXY. So if people use stock replacement instead of the ETF, yes, I would be selecting one of these. So which one? So these are the live ones. First of all, I would select this one. I would select the 107. I might even go 143 if it was a brand new trade, but let's go 107. I like to go over 100 days for sure, just to keep that theta as low as I possibly can. Second thing I'm looking for is to somewhat simulate the that's VIX. Same thing here. 111 days for the VXX. The second thing I'm looking for is to get a delta factor over 0.5. And if it's a fresh new trade that my volatility metrics are showing some conviction and it's definitely a green light. Right now is not a green light, so I'd probably go that 45 if I had to choose, the 45 delta. I'd go this 30 strike if I had to choose today. If I was really confident in the signal, like it was a normal position where, say next Tuesday or Wednesday, vol crush, and I have to get back into my tactical vol trade, at that point I might look for a slightly higher delta, maybe a 0.55 even, 0.54. So in that case, I might go as high as this 40 strike. But you said choose it today. So today I'm choosing the 30, and that's why. It's long enough out that the theta decay, because VXX put options are essentially insurance products. They will decay over time, all things being held constant. So I'm going to go with that 30, long dated, and be willing to rebalance that position if I can follow the trend for, say, 2 or 3 weeks. At that point, I would rebalance out of that and I would jump into the next month, which it's 143 today. It'd probably be around 110 days, 3 weeks from now, and I would rebalance into that one. And I just keep going. I try to keep those contracts 80, 85 days out if possible. You don't want to get into the 30, 40. Within a month, that theta starts to build, and you really don't want that. So stock replacement is meant to simulate the underlying, but you don't want to take on the negative theta that those positions will start bleeding and accelerating. Okay, what else is interesting here? I really wish that other first question, I remember it. I remember thinking, oh, I'm going to start with that one. That is a good question. And then it's gone. Mark Chen asks, I held UVXY, and sold it off at opening pop yesterday. Good. Not good, but good. You made money. In fear of reversal like most pop days. Is there a better way to observe and keep it with more patience? So you're long UVXY heading into this spike. You make a bunch of money Friday morning, but you sold out, in your opinion, probably too early. You want to know how you can maybe hang on to those positions longer. All right, Mark. First of all, great question. Secondly, congratulations on your profit. Third, if you know me and you follow my streams, I'm a polite Canadian. I'm not going to make fun of anybody, but I'm always going to tell people the truth. I do believe that when you're talking to people, the most respect that you can pay somebody is to just be honest with them. You can do it in a nice way, but you have to be honest with people. So I'm not picking on you when I give you my answer here. I'm going to go a little bit further than you probably expected, but this question stands out, so I'm going to use you as the guinea pig. Apologies. I'm not saying anything mean, but let me be honest. There is no way you should have been long UVXY heading into Friday. So that is the first thing that stands out to me right now. You're saying that you were long. Again, I'm not picking on you. This is just me being honest. You're saying, this is November 24th. This is the VIX futures curve, right? 10% in contango. VIX all the way down here. VX30 to VIX roll yield, super high. You're saying that you were long UVXY heading into this. In my opinion, in my humble opinion, that should never happen. You should never be long volatility based on a gut contrarian prediction of what's going to happen, because we know this is one of those times where showing a chart does actually help. Remember, geometric compounding, it doesn't actually look like this for live trading. We don't just short this thing blindly and make $1 billion, but it is somewhat useful to demonstrate that yes, this is a very difficult product to make money on the long side. So the first thing that stands out, Mark, is No, that was a mistake. Now, sometimes bad trades make money, which yours did. Congratulations. That sounds like impeccable timing, right? It sounds like a great trade. You were long UVXY heading into the fourth largest UVXY spike in history. Awesome. You made a bunch of money. You should never have been holding that position from the beginning. You want to look at volatility from a historical perspective, mathematically speaking, trying to maximize the probability of success. Trying to thread that needle, making money long volatility, is not a game you want to play. That's not even. I was going to say I was just in Vegas the last week, so it's on my head. I was going to say that would be like going into a casino and playing roulette. As far as I know, I think roulette has an odds, all things balanced out, of about 40%, give or take. I think that's the odds if you were to just blindly play for a long period of time. I think that's the casino has a little bit of an edge there. I think craps gets up to 45% or something, but it's not even that. I mean, the odds of you making money on UVXY are way worse than you going into a casino and making money on roulette. You're talking about a 5% of the time you're actually going to make money on that position. So that was a mistake. And I'll just illustrate what I personally do. You can see my trade dial for this strategy. We do hold long volatility. First of all, it will always be a 1/2 volatility position because this trade is a nightmare to manage, right? There's so much whipsaw on long vol, it's crazy. So I always take half positions here. I take VIXM here, which is a M4 to M7 VIX futures product. So it's basically this section of the VIX curve, which is flatter typically and moves slower. So I will use that one to represent my tail risk strategy. And then the third one, I will use 1/2 VXX. Always half sizes, slow moving products. But this sliver here, I'm serious, I'm only taking that 2 to 3% of the time. That's it. So what you want to do if you want to maximize your chance of success, long volatility, is you want to wait until the market has melted down and all your volatility metrics are red and everything that you track. I mean, look at the cash VIX, VIX 90, VIX, 3M, 6M, 1Y. Perfect contango chart. This is not a time to be long volatility. It's just you had some type of gut prediction. I'll wrap this up. I think I'm going in a little hard here. You had a gut prediction and it worked out. But please, in the future, just understand that in order to be a successful investor, you want to maximize the probability of success here. Long volatility is, it's just a notoriously difficult trade to manage. And look, the longer you stay in the casino, guess what happens to your money? So that's the first part. The second part, is there a better way to observe to keep more patience? So it's not correct yet. I still, even now after what happened on Friday, I'm still not long vol. That spike wasn't enough. I'm still not moving into it. But to be specific to you, it would have been more correct to not be long vol on Wednesday, heading through Thanksgiving, and then on Friday, after the spike, at the very close on Friday, to buy UVXY. I didn't. I think it's too early, but that would have been more correct than buying it on Wednesday. Far, far more correct. Because at least now, the VIX futures and the VIX roll yield, VX30 to the VIX index, it's significantly negative. So hold on a second. I just remembered that question that I'm trying to remember in my head. It had to do with the VIX VX30 roll yield. I remember the question now. I'm going to circle back. Awesome. Thank you, Mark. You reminded me. Yes, there's certainly ways to know when to go long volatility and when to hang on to those positions. But again, you want to default to math, statistics, and probabilities. So the UVXY, the best chance of success is when it has already spiked. Once it has spiked and the VX30 to VIX roll yield is significantly negative, VIX futures are significantly in backwardation, there's a lot of fear out there, the VIX is going up, so everybody's buying those hedges. That is a time when you can actually benefit from hanging on to your long volatility positions. So the worse the market gets, the more conviction you should have for that long vol position. It's actually not the other way around. I know it's super tempting for people to try to play the contrarian, but in this market, this isn't Warren Buffett back in the 80s. This is 2021. Being a contrarian will cost you money. Being a trend follower is the only way to make money these days. So trying to predict things that, oh, I think tomorrow it's going to do something that it didn't do today, not a good idea. The best policy if you want to be a successful trader is to always remember that tomorrow, on balance of probabilities, will probably look like today. Today will probably look more similar to yesterday. That does not suit the contrarian mindset. So hopefully you had your answer there. I, of course, have my method of knowing. I go pretty deep into these things. I have a lot of volatility metrics that I track. If my volatility barometer is 80% or more, yeah, no problem. I'll hold on to those long vol positions and I'll just ride them. If you want to understand something even further, what I would recommend you do, go onto my website. A lot of people don't know. I write a lot of articles as well. Long volatility. I've got several. Tactical long volatility allocations are difficult but important. Long volatility is a frustrating trade. Let me show you why. There's a lot of articles here that you can look at for exactly what I'm talking about. There's my first ever VXX trade. That was funny. I started trading these things early, so let me see this thing. August 2010 was my first VXX trade. And of course, like an idiot, I didn't really understand the product. I bought it long. So I went $66,000 long volatility back in August 2010. I remember this trade made a little bit of money, but stupid trade. Obviously, it's not a good. That's a contrarian. Mark, that was me being you back in August of 2010. The market was calm back then, and I thought, oh, it's going to spike for sure. It actually did. That position made money, but it was a dumb position, and I was wrong. But anyway, why is long volatility so notoriously difficult? Because you always give stuff back on the tail end. You have to hold it. It's going up for weeks. You think you're making a fortune, and then all of a sudden it's going to drop back. The market's going to vol crush on you, and it's going to reverse. And hopefully you're going to walk away with a little bit of money left in your pocket. All right, just because I spent a week in Vegas, again, it's on my mind. Vanessa went on this run where I gave her $40 on this little slot machine, and within 3 minutes, she was up to 190 or something. And I thought it was kind of funny. She's all excited, but I know what's going to happen. The longer you play, of course, you're going to give all that back. But the point of the long vol trade is in order to make those really big payoffs, like the real tail risk profit that you're looking for, you do have to hang on to it. So the answer to your question is, essentially, and you're going to have to measure how this applies to you, but the worse the market gets, the more sense it makes to hold on to that position. Don't be a contrarian, be a trend follower. If the market's going the other way strongly, try to ride it. You will probably kick back some of that profit, maybe a good chunk of it on the other side, but hopefully you walk away with a winning trade. You'll be up 50 or 100%, bleed back down to 50 or 25, and you'll walk away with a nice little long vol victory. The bad way to do it, and sorry, I didn't mean to pick on you, the bad way to do it is just to say, hey, the market's so calm for so long, the VIX futures are in strong contango, maybe tomorrow. I just can't get behind that. I don't do it. Okay, so I did remember that question while I was ranting here. I'll watch the rebroadcast. Hopefully I wasn't too rude there. I am a polite Canadian, but I always think honesty is the best policy. So there you go, Mark. The question had something to do with, am I surprised that the VIX futures are still in contango after that massive spike? That was basically what the question was asking. So remember where are we at here? The VXX had the number 4 largest historical spike in history yesterday. But it is a little bit surprising that this is the VIX futures curve. Do I want to disable my ad blocker? No. Continue to cite? What is going on? Hold on a second. Is it not going to let me? Sorry about this. This is bad content. Anyway, it's not going to let me do that, so that's interrupting my momentum here. Continue without disabling. There we go. Okay, so yes, it is surprising. If you look down here, we are still in contango, 2.12%. Still, after the 4th largest VXX spike in history, M1 and M2 didn't go backwards. So remember, I actually tweeted about this. That's what I wanted to point out. I tweeted about this. Hold on, I'm on screen share. This is terrible content. Bear with me. Don't everybody leave at once. I tweeted about this. Basically, extended clip talking about this is the current VIX futures. This was tweeted out yesterday during the big crash. You'll encounter different semantics, but the way I talk about it, this is the VIX curve in contango, but negative roll yield. So this is what I mean by that. Yeah, it's a little surprising that that front didn't go backwards. Contango itself is just when the M2 contract is trading higher than the M1. That's contango. That's all it means. So with respect to now, this 2645 is above the 2590. So yeah, it's a little bit surprising that it didn't dip the other way. But the far more meaningful metric is actually this third one, roll yield, as I use the term, because I'm a volatility ETP trader, is the difference between the constant 1-month maturity VIX future VX30 and the VIX index. With VIX futures below the VIX index now, this is negative roll yield. So what that means is the VX30, this is how the volatility ETPs actually derive their price. They are holding these two products, but this VIX index is where the expiration will be 24 days from now. This M1 contract and this VIX index will be the exact same value for that moment during expiration. There will be a gap between them for the whole month, up, down, wherever it goes. They're both freely traded products, but at expiration, this will converge. Now, whether it converges up, whether it converges down, I don't think it's meaningful to try to predict which one is which and try to decide which, does the tail wag the dog or does the dog wag the tail, whatever it is, but they will be the same. So this is actually negative roll yield, which means, sure, contango itself is still 2%, and you could say, wow, it's still positive. I guess we should still be short vol. The truth is, the way that the products are actually functioning, we have substantially negative VX30 to VIX roll yield. And I can actually go a step further with that. Screen share. What we can look at is VXX performance. Sorry, it'll ring a bell once I see it. Largest VIX spikes. Contango streaks. We are currently in the midst of a very historically high contango streak. So, and it's continuing, surprisingly. So here we are, number 2 all-time contango streaks. 213 days and counting. This is updated. I believe I updated it like a day ago or something. Oh yeah, after market close yesterday. So 213 days we have been in contango, and we're still going heading into Monday. Bear with me, I'm making a point here. This is the M1, M2 VIX futures, long-term median of 6.42. If you want just a data dump, percent of days in contango, you might be curious about that as well. 84% of the time, it is above zero. So that contango, 84% of the time, that's going to be the condition in the market. This is where we're currently at. So you can see it's been 3.5 years since we've seen a streak like this, but we are now seeing the first, I guess, signs of recovery after the vol apocalypse, which happened right there. It ended this streak rather abruptly, right? And we haven't seen anything even close since. But yeah, we're working on one now, 213 days. Here it is. This is since January 1st or January 27th of this year. That's how long the streak has been going. Remember, there was that massive VXX spike that day. Since then, VIX futures have not dipped negative. Right now, we are still at 2%. So it's positive. Great. The more meaningful point, though, I want to make here is that with respect to how the volatility ETPs actually function, the VX30 to VIX roll yield has gone negative substantially. Same situation here, 82% of the time, it is going to be positive. Most of the time, the short vol trade is going to be ticking lower, right? And people are going to be making money shorting volatility. 82% of the time, there is a tailwind for the short volatility trade. 8.54% mean. But here's what it looks like now, after that big loss. You can see several times along the way, the much more meaningful VX30 to VIX roll yield did dip negative several times. And right now it is negative 8%, I believe, 8.5%. So long story short, yes, I'm surprised that the VIX futures didn't actually dip into backwardation. But at the same time, don't really care because the volatility ETPs don't trade based on contango. Contango is just a snapshot picture in time that Had it persisted for several weeks in a row, maybe it'll start to mean something. Of course, the futures will align themselves based on that contango over longer periods of time. But what you're really concerned about is the actual functioning of the products. And right now, with VX30 to VIX roll yield being negative, which means, as we are looking at it, where's our VIX Central? We can see a pretty ugly looking VIX futures term structure here. Even though technically it's still in contango, the VIX index is all the way up here. The VIX futures are way down here. Again, I don't want to determine which one converges to which one, but as of right now, convergence upwards is the one that makes more sense mathematically. And you're talking about the short vol trade having a headwind right now. So contango, not overly meaningful. It's kind of like the VIX index itself. Very widely quoted. Everybody kind of knows what the VIX is, but not overly meaningful as our trading. You have to compare that to other things. VIX futures are the same. Absolute values like contango doesn't really mean much. Contango with respect to the VIX index and how they converge through that monthly cycle, now you're getting somewhere. And it is negative, substantially negative. So, yeah, the short vol trade right now is either out and in cash or hanging on by a thread as far as my portfolio is concerned. Okay. Sorry, I wish I could have actually clicked the name and read the question, but that's what it was. It was, am I surprised that we're still in contango? I am. That was a big move. What's your take on how the volatility environment in 2021 has been as compared to previous years historically? That's a good question. We've talked about that one a little bit. Sometimes it's better to just direct people to a full video rather than trying to do this in a 2 or 3 minute answer. But there's a video here called the Volatility Regime Change. And in that, I actually talked about several points that I could draw your attention to. But this is one of them. So this is my volatility barometer. And it's essentially anywhere from 10 to 15 individual volatility metrics, right? Everything that I update from my community every day. There's several others. I've got tons of metrics. The volatility barometer is my comprehensive volatility index. It's way more accurate than, say, the VIX or any of the individual metrics on their own, like M1, M2 VIX futures. The volatility barometer is far more accurate than that. And so you can see in this picture, the volatility barometer pre-Volpocalypse was averaging 40.6%, basically 40%. Since Volpocalypse, it's averaging 60%, which I don't know if that sounds like a lot, but it is. The way that this is constructed, using percentiles and watching it move around with multiple metrics, a 20% difference is very significant. So that's the first thing that I would say is, yes, absolute clear volatility regime change since Volpocalypse. Very difficult and unheard of to see those low levels. We saw the VIX in the 8s, right, closing in the 9s. If you want to see the data for that, I always have data for everything, right? So let's try to find that. VIX lowest closes. There it is. So lowest close, 914. We're not going to see this. You can see that I highlighted in blue 2017, basically, and just the first month of 2018. You can see it's just a sea of blue. That was a crazy low vol environment in 2017. But we're not going to see the VIX in the 9s anytime soon. This is a different environment. Right now, even the markets were calm heading into this massive spike. VIX was still in the 18s. So yeah, it's different now. We are in a different volatility regime. We are not seeing those low levels anymore. And until we do see those low levels, I think trading vol conservatively makes more sense right now. It really does. There was the golden years of the short vol trade, which I fully participated in. And, I like to think I added a little bit to that community because I've been writing and, doing the VTS community for 10 years now. I fully participated in it. Now, it was great. From 2011-ish to 2017, it was a different time back then. I'm not going to say it was easy. Still, you got to know your stuff, but easier. I don't think that that's unfair to say. But yeah, we're in a different environment now. So, and another thing that illustrates that is 5 historically large volatility spikes this year alone. That's big. If you look at the largest VXX spikes in history, or at least the history that we have, simulating back to 2004, most of them, probably 70 to 80% of them, maybe 80% of them, are going to be fairly recent, right? If you just kind of scroll down through these dates, 18, 19, 20, 21, like most of these, I don't want to do it on the fly, but let's say 70% of them are going to be within the last 3 or 4 years. And 5 of these, including this one down here, this year, 2021. So that's what I would say. 100%, it's a different volatility regime, which should change the way that you trade. And you don't try to just keep jamming the square peg in a round hole. You know, what worked in 2013 might not work anymore today. The blind short vol stuff doesn't work anymore. You need more than that. Yeah, it's difficult. If you look at just an example from yesterday, if you're trading 2 times leveraged ETFs, for example, the SSO, right? The S&P 500 was down 2.27, I believe. SSO, let's say 4.5. Well, the SVXY was down 12.8. So if you're comparing the two, SSO on the positive side, when they're both working well for your portfolio, they're more or less the same, right? SVXY might outperform a little bit, but basically a 2 times S&P and a minus 0.5 times inverse short vol, they're going to be very competitive on good times. But on bad times, nowadays, that short vol position might cost you more than the 2 times leveraged long equities position. So you've got to be careful trying to represent all of your quasi-market longs and stuffing short vol in there. There was a time when that might have worked. There was a time in 2014, for example, if you wanted to go long the stock market, well, just buy the XIV instead. It's a better proxy. It makes way more money in good times. And yeah, you're going to get crushed on bad ones, but it far outweighs. These days, that relationship has changed dramatically to the point where I know for my portfolio, and I'll just, obviously you don't have to be a member of the community to participate in the live streams, but you can see my portfolio is, we're down to 10% allocation to the short vol, the pure short vol strategy. This one has volatility elements in it, especially on the long vol side. That's where it happens. The 80% range is VIXM. But we're down to a pretty low percentage. And I'm actually doing 2 times MDY, 2 times S&P, and 2 times the Qs. I'm still using volatility metrics to guide all of the trading decisions, right? You got to remember that even if you've never traded short vol in your life, if you're long the stock market, you're a short vol trader. That is a proxy short vol position. You want volatility to remain stable and low and the market to continue higher. So these days, I would default more to the 2 times leveraged equity positions to represent your quasi-market shorts or your short vol, rather than trying to stuff in volatility in its place all the time. It's not working as well anymore because the risk reward has been skewed, where in the past, if we can see the VIX eventually go back down to 10, then yeah, the SVXY is going to start to make a lot more sense. And the new SVIX, for example, might make a lot of sense to use as a small percentage. I don't know, 20% of a portfolio. Right now, it doesn't make much sense because that relationship is wildly skewed. Losses are punishing. Periods of long extended gains are far few in between. So yeah, that's what I would say is the short vol trade's not dead. Remember, everything long equities is technically short vol. I mean, if you want to get specific about it, the short vol trade's not dead, but it's different. It's definitely different. And you have to understand that it's been 3.5 years. It will eventually revert back. It always does. But right now, shorting volatility is difficult, especially with 5 major one-day spikes out of nowhere. Did I move to safety on Friday's move? Yeah, for the most part. I wouldn't call it safety yet. I'll explain what I mean in a second. This is the portfolio. This is Friday's email. So this is the leveraged portfolio within VTS. So we are using, anytime we're using equity positions, I'm actually using 2 times the equity positions. I've been able to manage the drawdowns very successfully, so I feel like going 2 times leverage makes a lot of sense certain situations. And this is what it looked like the day before the big spike. So we are in all of these products. And this is what it looked like. We have an unleveraged portfolio as well. This is what it looked like yesterday. So I essentially rotated out of 3 of my strategies. SVXY still at a small 10% allocation. This one uses VXX put options. That one's in cash. These 3 rotated out. Now, I wouldn't say that it's full safety. First of all, we rotated from 2 times equities into 7 to 10-year treasuries. This is safety, right? Treasuries, hopefully it's just going to kind of tread water. It's not a position I'm trying to make a lot of profit on, just a little bit here and there while I'm parking cash in safety when I don't want to be in equities. But the other 2, I wouldn't call them full safety yet. This is moving into IYR, the real estate. Definitely much lower beta to the S&P than the 2 times S&P. But it's not full safety. If the market recovers Monday, this position will likely be up money as well. And same with this one. We move into utilities because they perform much better than certainly 2 times equities during a crash. Sometimes they even do quite well. We don't move to cash quite yet. But again, I wouldn't quite say this is a safety position. I always give everybody the daily beta factor of the portfolio. And on this day, we're still 0.39 beta to the S&P. So if on Monday, the markets are actually up and we do see that vol crush that everybody's kind of expecting, this portfolio will make a little bit of money. If we see a devastating day on Monday, which of course, as I illustrated earlier, does happen from time to time, then I'm probably going to lose a little bit more money. But yeah, I'm in largely safety positions, not our full-on safety. My beta to the S&P can dip significantly negative. Like my portfolio is also a tail risk portfolio, so we can go basically aggressive short the market as well under the right conditions. Right now, we're balancing around that 0.39. It's typically over 1. Right now, it's only 0.39. So pretty close to what I would call safety. And we'll see what happens Monday. It's going to be, could be fireworks. It could be vol crusher. Who knows? Who cares? I'm trading for 30 years. I'm not at all concerned about what happens on one day. It'll be interesting, and I'll be there for the open, of course, but yeah, whatever happens, happens. I'm never overly exposed, so you never want to be in a position where you really can't sleep. Like, I'm not worried at all over the weekend. I'm going to do my work. I'm going to edit videos. I'm not thinking about, oh my God, I hope on Monday, come on, please go up, 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 up. I'm not one of those people. It is what it is. Up or down, my portfolio will handle it. I'm going to go running in a minute. I can hear it's pouring rain outside, but I always run no matter what. Just like David Goggins would say, you never not go. If today's the day, then you go no matter what it looks like outside, and it's miserable out, so I'm not looking forward to it, but I'm going for a run in the cold Vancouver rain. Are you personally only using leveraged total portfolio now? And if so, why? Is the need to catch up really a bad reason to use leveraged total portfolio, provided one can handle the increased drawdowns above TPS? Great question. A lot of little questions layered in there. Leveraged total portfolio, TPS is total portfolio, right? Thank you. Yes, I am now married. Vegas wedding. Hopefully that allows me to get back into Taiwan. Okay, good question. So no, I use both of them equally. The only reason that you see that you would think, oh wow, he only uses the leveraged total portfolio. First of all, for anybody just catching up really quickly, we have 2, the leveraged and then the standard, right? So this portfolio will be using 2 times ETFs when appropriate, usually only for equities. And this one will never use leveraged products. It will use the SPY, the QQQ, the MDY, no leverage of any kind, right? And the results are different. Right? Of course, you would expect the leveraged portfolio if I know how to manage drawdowns. Remember, adding leverage to something that has bad drawdowns will actually make your long-term results worse. But I'm pretty good at managing drawdowns. My top priority is always risk management. So the leveraged portfolio is clearly better than the unleveraged portfolio. Both of them still crush the benchmark long-term, 60-40 VBanks. But yeah, leveraged portfolio given my success at controlling drawdowns, you could argue this is the better portfolio to follow. But I follow both. Like I was saying, the only reason it appears like I'm only using the leveraged one is that this isn't my long-term portfolio. This is just a account that I funded so that when I'm doing live streams, I can actually show people stuff. Like I like to show a portfolio with real money in real trades, not having to worry about clicking the wrong button and revealing, information or account numbers. So this live stream portfolio is only trading the leveraged total portfolio with one substitution. Instead of aggressive vol, which uses SVXY, I'm actually substituting in the tactical vol because this uses VXX put options, and I just find it's more interesting. In live streams, it's just more interesting to show the VXX put options than just a SVXY. But yes, that's what you will see. But rest assured, I am trading a mix of both in my own portfolio. So I use Interactive Brokers. Obviously, you can use any broker you want. The live stream account is using Thinkorswim. I think it's beautiful. Everybody loves looking at Thinkorswim. The TOS platform is awesome. And then Interactive Brokers is the ugliest thing in the world, but that's where my long-term portfolio is. And then I balance the two equally. I'm looking for building my wealth over 30 years. I'm not looking to do it. I don't need leverage to do it, but I've been very successful trading the leveraged portfolio. I see no reason why. So you said, is the reason because trying to catch up? You would not be trying to catch up. I don't view the leveraged total portfolio as high risk. The catch up part that you're referring to is a video I made previously saying, why are you using leverage? Are you trying to catch up past mistakes and now you're trying to jam in your short vol and naked short UVXY garbage that people are doing out there? Are you trying to do that because you're trying to catch up? It's never a good reason to use leverage. But a good reason to use leverage is if you can actively use the leverage to your benefit long term. And clearly that's what's happening within my portfolio because we do rotate out. We took a hit. Not going to lie. I showed it before. I lost a chunk of change yesterday as well, just like most people did, but only one day. So the markets are down 2% and I'm not happy, but I'm in safety now. So great. The markets are down slightly and all my portfolios are basically beta to the S&P to where I don't have to worry if this is the beginning of a Q4 2018 that's going to go down 20% or worse. I mean, they saved it through monetary policy last time. I don't think that's going to be available this time. So what if this is the start of something terrible? Yeah, I didn't have much fun this day, but I'm out and I'm safe. So it's fine. In that respect, I would say, no, I'm not playing catch up when I do it. It's actually quite a well thought out portfolio. I actually have the drawdowns. Sorry for all the scrolling. Hard on your eyes. I've been successful at managing drawdowns. I don't think that this is considered plugging in leverage to try to catch up anything. I'm very confident that through tactical investing, while it is certainly extremely frustrating when you get whipsawed, long term, I am completely confident that the long-term leverage total portfolio will also be able to manage drawdowns effectively. So I use 50-50 of both. You'll see only leveraged positions during our live streams, but my long-term portfolio at Interactive Brokers calculates it all, and I basically just use a mix of both. I like both. I'm not a risk chaser. Nothing makes me happier than seeing a consistent 10-year chart that's going upwards. That's what thrills me. You'll never see me on Twitter bragging about how much money I made in a day or 2 days. I don't do that stuff. You might see me bragging 20 years from now, showing pictures of my portfolio that looks like this with very little drawdowns. You might see me brag about that, but give me another decade before I turn into one of those Twitter people that, post all the performance. How much volume in the VXX is from people with How much volume in the VXX is from people with a bigger edge than you have? And will they eventually make everyone else lose money long term? Well, now you're nailing me down to trying to determine where my place in the grand vol space is compared to other people. Should I use this as an opportunity to go off on a tangent about building up yourself? Essentially, what I wanted to say is you have to give me a little bit of leeway. I'm not an arrogant person at all. You'll never see me bragging on Twitter. Go through my Twitter profile. I mean, even when I have a slam dunk year, I don't say anything. I don't brag about victories. I don't make excuses and losses. So give me a little bit of room here. But I'm very confident that I'm, up there as far as success. And I'm maybe the only person that you'll see who literally posts their live trades for over a decade publicly. And I've gone 10 years with no haters. I don't like to talk about the size of the community, but I'd have 1,000 people on Twitter saying he's lying, those results aren't real, I'm paying him $80 a month and he's not getting those and mine doesn't match his. 10 years, not a peep. I'm probably the only person that's actually can show a track record, and it's good. So I'm confident in my place in the space, right? I'm not going to nail down exactly where I am, but further than that, you don't want to compare to other people. You just want to compare to yourself. And what I know is I was successful at trading volatility since 2005, but I'm smarter now compared to myself today in 2021 than I ever was in the past. I'm just learning more and more every year. So the general point is I'm not trying to out-edge other people, if that makes sense. I'm trying to out-edge myself. I want to make sure that when I go to bed at night, tonight, I'm a little bit smarter than I was yesterday. That's what I'm trying to do. And so for me, I've been building my edge and learning over time and adjusting my portfolio and managing risk. And every year that goes by, I am getting a little bit better at this. So no to the first part. I don't think everybody out there is going to suddenly out-edge me, because few, if any, people out there actually outwork me. So not only do I have 17 years of experience, but I also have quite a, some would argue, an unhealthy workaholic attitude where I really do grind. You're not going to outwork me. As far as the general public, yes, I always say volatility trading, options trading, unfortunately, it is a highly competitive industry. If you want to be good at something, at the end of the day, it is relative to other people, and you do want to be better than them. The them, in this case, aren't dummies. We can talk all day long about how 85% of asset managers underperform their benchmark and look at the hedge fund indexes and they're all terrible and, oh my God, hedge fund managers are idiots and nobody at the Fed knows what they're talking about, and all these things that we say in conversation. I assure you, Wall Street are not dummies, and that's who we're competing against. These are the smartest, most educated people on the planet in financial markets. Performance aside, maybe they have handcuffs a little bit because they're managing client money and they can't do certain things that they would like to do. Who knows, for the reasons that of just the massive, embarrassing underperformance of the industry. But they're not dummies, and that's who we're competing against. So if we're competing against people trading VXX, yeah, we want to be better than them. We want to make sure that we've got our edge in place and that every week, every month, we are better than we were previously, which means if you're outworking them, how can they catch you, right? You'll always maintain your edge. The second part about this, sort of built in there, is will they essentially phase everybody out? I think what you're getting at is, will there come a time when retail people like you and I just can't compete with them anymore? For that part of the question, I would say not only is that not true, but it's actually in your favor. And I referred to it a little bit just a second ago, but you want to make sure that you're a person with the least restrictions possible when you're managing your portfolio, because those people, while they may have a better education in the financial markets than you, maybe they went to Wall Street, maybe they have a PhD from Wharton, maybe they're an engineer, who knows? If you have less restrictions and handcuffs on what you can and can't do within your account, trust me, they're trading large capital. They've got regulators to answer to. They've got a compliance officer breathing down their neck. If you can get yourself into a position where you can actually remain nimble and you can cycle out of your portfolio in a day or two when risk presents itself, they can't. They've got all these considerations in front of them. So it's actually, there is one way to look at it that, yes, those big fish, there are certain things that they can do to quasi-manipulate the market. I never say it's manipulated, but yeah, you can shove people around if you've got the biggest wallet in the room. But there's also a way to look at it that you retail traders out there, you do have an advantage. You can be nimble. You're small. You don't have a compliance officer telling you can't do something. If it's best for your money and your long-term success, you can do it. That's, say, one of several reasons why I'm successful with VTS, managing the community, because I'm not doing anything to impress anybody out there. I've never created a strategy. I've never marketed anything to get followers. This is literally my portfolio. Everything I'm doing, and I don't mean to be selfish, but it is a selfish endeavor. I am managing my own portfolio the best way I can with the least amount of restrictions possible. And I'm sharing it publicly for people who want to be nimble, tactical investors alongside me. That's not the situation in the financial industry. So I would say look at it as an advantage. Number one, outwork people, just in general. I don't care what you do for a living, outwork people. I was doing that since my pro golf days. Talent is a thing. Education is a thing. But nothing trumps work ethic. So do that. 2, always make sure you're smarter next year than you were this year. And number 3, use your disadvantages as a strength. As a retail trader, don't look at it as a rigged game that you can't win. Look at it as, wow, I'm actually way more nimble than these guys. And that Wharton graduate with a PhD can't do the things that I can do. So maybe I can actually beat them. You can get into this options market and you can outmaneuver people. They can't do that. So I would imagine a significant portion of the financial industry underperformance is because of, that compliance officer breathing down your neck. Oh, you can't do that. That violates your risk policy. And then you explain to them, well, no, it actually doesn't. We've got this covering it. And they don't want to look at it as individual. They want to look at it as, not a holistic approach, but something that violated a regulation. And it doesn't apply to you. So you can still do it. You can beat those guys. Hopefully they're not smarter than you, and hopefully they don't outwork you. But even if they do, you can still hang in there. There is hope for all of us retail traders. Beyond hope, there is promise. You can do it. I'd like to believe that I'm proof of that. And certainly you can do exactly what I've done. There are many, many ways to make money. I never say mine's the only way or the best way, or I don't force anything. I don't market anything. But yep, you can do it. You won't lose your edge. If anything, you'll gain edge over time. Follow-up question on butterfly. That rings a bell. Did you ask a question about... Yes, you did. That rings a bell. So there was 2 questions that that haven't shown up in the stream, but they were asked before I clicked go live. I believe you were the second one that said, should you trade butterflies as individual legs, or should you do the whole thing at once? I believe that was your question. So do I have any broken wing butterflies on live right now? I should have several. Let's trade here. So say the most relevant one, just this broken wing butterfly here. It's 3 legs. This is a 13, 15, 16 broken wing butterfly. The question was, before I get to this follow-up, should you leg into these individually? So should you find the 15, buy that one, find the 16, short 2 times the contracts in that one, find the 18, do that one? Should you do that, or should you trade it as a full butterfly? My answer is probably not going to surprise you, but I do remember you asked it. You've got to trade it as a butterfly. You'll run into a lot of problems if you're trying to leg into spreads. There's 2 that are glaring, but of course there's several more, maybe 3. Let me think. The first problem is when you're doing butterflies themselves, you do have to try to get the best price when you're option trading. You don't have to nickel and dime. They're computers. They're quite quick, and you don't have to sit there for an hour trying to get that last penny. But you do want to get the midpoint and the best price you can get. So if you have to do that once with a broken wing butterfly, you might have to give up a penny because it's a spread. You might have to give up 2 cents. But then you're starting to leg into individual ones. You still have to chase those good fill prices, and now you're going to lose 3 times, right? You could potentially lose 3 times, not necessarily, but you could. The second problem is while you're trading the first leg, maybe the market's moving a little bit and maybe it's moving the wrong way. By the time you get to filling your short and then you're following long, the market has moved on you and now you're chasing the price the wrong way. Of course, you could say the same thing. Maybe it's beneficial, but we don't roll dice with our portfolio. We don't take those chances. The price in the moment is what I want to get. I don't want to say, well, there's a 50-50 chance this trade might get significantly worse 5 minutes from now. I don't want to do that. The third thing, of course, is you're going to deal with an additional trade fee, which you don't want. So always trade your spreads as a spread, open them and close them as a spread. I suspect this question was being asked because you are trading with a broker that doesn't make it very easy for you. Of course, my live stream account is Toss, super user-friendly. Interactive Brokers is actually quite easy to use. It's just extremely ugly. But Interactive Brokers, you can just use the option builder and you can do it obviously in a one spread. All brokers should. If you're in a situation where you're actually asking yourself that question, wow, I can't figure out how to do this as a spread. Should I leg in? The answer is no, and then you got to get on in customer service and figure out with your specific platform how you build that option as a spread, because you should open and close them as a spread. Okay. Now the follow-up. Follow-up question on Butterfly. How do you calculate the percent profit? Do you take the profit of the combo and divide by VXX price? I don't like to get into the math too much because typically I will just default to most brokers should just have a picture of it for you. And if they don't, you're using something pretty old school, right? I mean, even Interactive Brokers with their incredibly ugly software that boggles my mind why they don't update it and make it look a little bit nicer. But even then, you can go into the analyzer and you can see everything in front of you. So how do I calculate? Well, I did a full live stream just previous to this one, how to calculate the actual allocation size. Why is this 1% of my net liquidation value? That's easy enough to do. And then I can see my profit right here. I don't need to calculate it. If you wanted to calculate it, you just have to remember that a broken wing butterfly has that $1 strike gap between the 13 and 15 in this case, whereas on the high side, the 16 and 15 are next to each other. So there's always that little lopsided thing you have to calculate as well. If this was a standard butterfly, then anytime you're dealing, what is this, UVXY, I don't need 100 days. If it's a standard butterfly, you can just see it in front of you. But also, it's a limited loss defined risk long option spread. Oh, it's going to be weird looking because of the big spike. Let's go 22.18. You can just see it. I'm paying 22 cents to get into this butterfly. Well, let's say I sell it for 30 cents. I make 8 cents times the number of contracts. That's easy enough to do. When you're dealing with a broken wing butterfly, just remember that there is that little strike gap. And so you have to add that $100 or deduct from that $100 when you're doing your premium plus or premium minus. It's just a additional step of $100. But I would say just get used to looking at them and just knowing what you're looking at. I don't need this picture to know what my trade will look like at any given time. I've traded thousands of them. I would say that hopefully you can get with a broker that doesn't, I mean, I don't know what Fidelity or Schwab or any of these things look like. I've never used them. I'm IB toss only. But if they're super ugly, I mean, move. I don't ever want to say, inconvenience yourself by doing that. But for me personally, if I didn't have toss as a sort of a backup to use, and then I jump over and I execute with IB, but I'm still looking at toss when I'm analyzing. If I didn't have that, then I'd move to toss. Just the importance of having something that you can look at 10 hours a day is, it's valuable. So don't need to calculate. You should know. But if you do need to calculate, it's a long option. Premium, and then remember that $1 gap. I've ever been to Las Vegas. There's a lot that can disturb. Congratulations. So Vegas is a weird place. I didn't enjoy it at all. Vanessa and I were both saying that we travel a lot. We basically perpetual travelers. But this is the first vacation I can ever remember where I actually wanted to go home. Every vacation, every place I've been to has something great about it, and something that you're like, wow, I wish I had another week to do this, or I wish I had just another couple of days. I had one thing on my list I didn't get to. Not Vegas. I was so happy to leave. I couldn't wait to get to the airport. I was 3 hours early to the airport. I just got to get out of that place. It is... Sorry to anybody who lives in Las Vegas. If you trade with an ugly broker, move brokers. If you live in Las Vegas, look elsewhere. That's all I will say. Or don't go to the Strip. The Vegas Strip is... Nothing good happens on the Vegas Strip. All right, so this has been a painfully long live stream. I do appreciate everybody watching, though. So if you don't mind, if you're new, they look somewhat like this, but I do try to keep them about 1 hour. Subscribe to the channel and follow me on Twitter. So my Twitter handle, just so you can see it, is @VolatilityVix. Follow me on Twitter because I will always notify people of the stream beforehand. So you won't ever miss the streams. @VolatilityVix. Plus, I'll post a few things here and there. I'm not overly active on Twitter. I've only posted 6,000 tweets or something, which is extremely low. I've seen people in the vol space with 50, 75,000. I don't know how people do that. Twitter is, I don't know. It's not overly interesting to me, but I do post. MDY crashed even more than the SPY did last Friday. So as a person who, one of my 3 strategies does use the MDY, this is what I felt like on Friday. But yeah, this is what the streams look like. Give it a thumbs up on your way out the door. Very much appreciate it. And I'm going running in the cold. Hopefully you're doing something more fun than me. Thanks for watching, everyone.